Thank you, everybody, for attending. As Hugo said, my name is Shane Clark. I'm the president of Euro-American Financial Advisors. We are registered with the Spanish investment authorities as an independent investment advisor. We also have a sister firm, International Asset Management, in San Francisco, California. And between the two firms, we work with U.S. expats in Europe, particularly in Spain, helping people manage their portfolio in a compliant way, but also tax efficient. So let me just go to this first slide. So this is something I get asked all the time. What's the one thing I should do before I move? Or what's the biggest mistake I should avoid? And there is a pretty good answer to that. So before you move, the most important thing from a portfolio management standpoint is making sure that there's no interruption with having access to your money. So something that happens with U.S. brokers and U.S. custodians is once you update your address and you tell them, hey, I moved to Spain, they often won't be able to continue to work with you. And that's something I'll go into more detail on. But working with a U.S. broker who works with U.S. expats before you move can ensure there's no transitional problems. With everything else that occurs when you do move, this is one thing that you can do ahead of time that just gives you peace of mind and ensures continuity without having to worry about not having access to your money. So some of the reasons why they cannot work with you are these things. So if we start with that middle tile, citizenship-based taxation, this is a unique situation to the United States. We're one of two countries in the world where you're continued to be taxed or to have to file a tax return in the US even after you move abroad. So for example, if Hugo moved to Spain, he'd pay taxes in Spain. For US citizens, once you move to Spain, typically you pay taxes in Spain, but you still have to file a return in the US. And I won't go into more detail because I know we have that covered today. So filing US returns is quite unique and something that you need to work with a professional on. FATCA, the Foreign Account Tax Compliance Act, this is something that they put in place years ago now, but essentially it's requiring firms to report about US accounts abroad to the Treasury. And that's why a lot of local banks, particularly in Germany, won't work with you as a U.S. citizen. FBAR is report on foreign bank accounts abroad. So if you have a bank account with Santander, for example, you have to fill out a special form when you sign up for that account. And that's just so the IRS knows you've got money abroad. PFICs, passive foreign investment companies, we'll talk more about this, as I'm sure Lewis will as well. But this is essentially a foreign mutual fund or exchange traded fund, and it creates a lot of problems for your U.S. tax reporting. So we want to avoid those. You want to stay invested in compliant instruments. MiFID is Market in Financial Instruments Directive, and that really is to set out what your rights are living in the EU as an investor. It also affects us. So we're registered with the Spanish investment authorities, and our US firm is registered with the Securities and Exchange Commission. So we always advise people in the US, you wouldn't want to work with somebody who isn't licensed. It's the same thing here. So you can go online, you can see if these professionals are licensed, what qualifications they have, if there's any outstanding situations for their firms. The last one is called PRIPS, Packaged Retail Insurance and Investment-Based Products. That's always a mouthful. And what that says is if you're living in the EU for US exchange-traded funds, which offer their funds to people living here, this is an EU legislation that says these US ETFs need to produce a key information document. They don't produce it. So that's why you've probably done some searching online and found out that you can't buy or hold US ETFs once you move overseas. And that's the piece of legislation why you cannot. So what we do, really two services. We offer cross-border investment advice, and we structure your portfolio in a way that's compliant here in Spain, but also in the US, and we coordinate with the rest of the members of your financial team, which would be Spanish tax preparer, US tax preparer, making sure that it's tax efficient and not causing any problems for you in either jurisdiction. And then the second thing we do is financial planning. So we look at, okay, you're moving to a new country, you're going to have new expenses, your whole life's going to change. What can we do from a financial standpoint to ensure that you're continuing to live the lifestyle you want well through your retirement years? So when you move overseas, really you need a cross-border investment advisor. You need somebody who understands the local taxes, the local regulations, constraints that might affect you that you might not be aware of. And that's something that we do with prospects and clients on the first couple calls, making sure they're aware of these different issues and things in Spain that they might not know about or might not exist in the US, like wealth tax, for example. In Spain, there's a wealth tax. There isn't one in the US. It can be quite scary when people first read about it, but it's very nuanced and very different in different regions of Spain. So our firm is MiFID licensed. We can passport now to 15 different countries in Europe. I have the European Financial Planning designation, which is like the certified financial planner in the US. And it's just, we were expats. My partner, Tom, in the US, he's originally from Canada. I'm originally from the US. So I've gone through all these issues myself, but also we've seen many different situations over the years with clients. And when we have different calls with tax advisors or partners, we might know something that we think that we should be asking that you might not know about. So it's beneficial to work in a team for these situations. And this is something that we do, maybe not explicitly, but we have a checklist we go over when clients first come on board. And we look at, all right, there's 3 kind of areas here to becoming an expat. Issues before you move, issues just after you move, and then ongoing things that we always need to stay on top of. So getting a visa, if you qualify for a tax advantaged visa, like the Beckham law, for example, there's different visas that can help you get on that. And it's important to work with an immigration attorney who can tell you if you could qualify for that better tax program and get on it if you could qualify. You absolutely don't want to if you don't, but it's important to try to optimize that. Same thing with residence permits, real estate, all these different issues we want to look at before you move so you don't have a surprise after you move or on your tax return once you move to Spain. So for example, this happens frequently for us. If you have a house in the US, you want to hold on to it for a couple of years, you move to Spain, you become a tax resident in Spain. If you then sell that house, you're going to be liable to pay capital gains on it in Spain, which is probably at a much higher rate than you would in the US. So these are types of conversations we have in the financial planning phase. So are you sure you want to hold on to that house? What's the plan for that? We just want people to be aware of these issues. Currency transfers, I'll talk more about that, but there's currency risk and there's what's the most optimal way to transfer currencies. And we'll discuss that kind of as we go. So financial planning, there's a couple parts to what we're looking at when we say financial planning. What we do is we prepare 3 personalized financial statements. So we do a balance sheet. We look at your total asset level. We do an income statement, looking at how much money is coming in from passive or active streams, Social Security, a government pension, whatever that might be, versus your expenses. And then we also look at preparing a statement of cash flow. So when does this money actually hit your books, so to speak? And then we project all of that into the future, and we incorporate any goals you might have along the way. So maybe you want to buy a new house in Spain. Maybe you want to fund grandchildren retirement accounts. Maybe you want to get a convertible. Whatever that might be, we include that in the financial plan. And then at the end, we get an idea of a percentage of success rate. So we think 92% probability you can achieve all these goals given your level of capital. And there's lots of different scenarios we can run. A common one is, should I rent or should I buy a house? Other ones, people might not know about some of the other costs, like the wealth tax. So we look at different aspects there. Custody, this was the number one issue, when we first started. So I think having a conversation with your custodian and broker 6 months before you move is a great idea. If it's Merrill Lynch, Wells Fargo, whoever it might be, call them up, tell them, hey, I'm going to move to Spain. And I think it's important to have that conversation with your advisor, but then make sure that your advisor speaks to their compliance department, because that's really the key aspect there. Because lots of advisors say, hey, it's no problem for me. They never enter that into their system. Then they tell you once you move, hey, I can't work with you anymore. And that's a nice thing to avoid. So what are your options? There's two options, really. There's Charles Schwab, which has Schwab Domestic in the US, and then Schwab International once you move to Spain. If you sign up with Schwab today, they'll open your accounts. Schwab Domestic, you can transfer your assets tax-free. Then once you move abroad, it's one form, change of address, Schwab International. There's no problems with that. The other option is Interactive Brokers. Interactive Brokers is a global custodian. Some people haven't heard of them as much. For a long time, they were more on the institutional side versus the retail side. So lots of companies like mine or money managers have used them for years, but they're getting more on the retail side as they've progressed. So there's two options there. There's keeping money in the US or investing abroad. People often ask us, moving to Spain, I want to have all my money in Spain. And typically, if you move your money to an EU bank, private bank, there's issues with what you can invest in. So you don't want to invest in funds. So then it has to be an individual stock, individual bond portfolio. And oftentimes private bankers don't have the expertise to put together a portfolio for US citizens. So they often put you into these passive forward investment corporations or funds that create the problems for you kind of down the line. And you should also look at the fees. The US financial system is extremely efficient, transparent, low cost. Over here, they often would charge maybe 1% at a private bank for just trading your account, let alone the fees for the individual products. So it's important to look into those things. And then also looking at financial system diversification. If you have a taxable normal brokerage account with Interactive Brokers, once you move over here, that's actually held in Ireland. So you're outside of the US financial system, and importantly, it still produces 1099s. So you still have those tax reporting forms when you file your US taxes every year, which is very important. We've had a case where we had a person who was banking over here. They got on the Spanish Golden Visa by investment when you could still do that. And they weren't a tax resident in Spain. So the situation then is they have investment income, but because Spanish banks don't produce 1099s, it was being taxed at ordinary income in the US instead of long-term capital gains. And there's not a solution to that. We've been trying to find one, so it's important to know these nuances, I think. Some other issues, tax reporting. Like I said, the 1099s are very important for paying what you should be paying in taxes. And also, if you ever get audited, you want to have the right tax reporting forms that the IRS is expecting. Safety, this is a little bit different. So in the US, we have SIPC insurance, which protects investment accounts up to $500,000. In Ireland, the account insurance only goes to 22,000 euros. So with either company, Charles Schwab or Interactive Brokers, you don't expect them to go bankrupt. They're large companies, but it is a risk that we should think about. And then other issues, currency risk. This is probably one of the biggest ones that people, are feeling these days with the fall of the US dollar relative to the euro this year. So looking at currency risk, there's really two things. There's what's the most efficient way to move money from US dollars to euros. And there's about three options there. One, you go to your bank, Chase Bank, say I want to wire money from my bank account in dollars to a bank account in Spain in euros. If you do that, the best case scenario, they're going to take around 3%. If you use a currency broker like Wise, Spartan FX, MoneyCorp, anyone like that, they're usually going to take around half of 1%. And if you use a broker like Interactive Brokers, if you have us do the currency exchange, it's usually around 0.25%. So that's the most efficient way to do that. Also, if you're looking at purchasing a house, someone like MoneyCorp has an individual currency broker you can work with. So if you say, hey, I want to move $500,000 in the next 6 months, they can help time that. They're really focused on this, and they can help you make the most cost-effective transfer there. Another issue, so if you're looking at currency risk, how do I, if all of my expenses are in euros and all my money is in US dollars, that's a currency risk. So how do we mitigate that? One way is called indirect currency exposure, and that's where we keep your account at Charles Schwab. We buy US exchange traded funds that hold European companies inside. So basically what happens when the broker buys it, they take US dollars, they buy European companies, converting the currency into euros. It's held in dollars. When you sell, they convert it back to dollars from euros. So if the euro goes up 10% relative to the dollar during that time period, you'll see that appreciation in the share price of the ETF. That's the easiest way to do it, to manage the currency risk. The other option is with interactive brokers. So you have your account in Ireland, for example. We put together a portfolio of individual European stocks, European bonds. They're held in euros. We never convert the currency if it's already in euros. So you hold it that way. We can wire money out to your Spanish bank or your Wise account in euros generated from that account. So some financial issues here, U.S. exposure. A lot of people ask us, have we done anything differently with everything that's going on in the world? And the answer is yes. Probably around last December, we made a pretty big shift in our portfolio management with the U.S. firm away from the U.S. dollar. So we were probably around 70% U.S. focused before. Now we're around 50% U.S., 50% international. And then of the international pool, that includes international developed markets like Japan, Australia, New Zealand, but also emerging markets, and of course, European exposure. So we put together globally diversified portfolios for our clients, and we also address currency risk in there as well. We also have gold in the portfolio, around 10% at any given time. That helps even out some of the volatility. Anytime there's a panic, the price of gold goes up. So it's a nice way to have some stability there. And then in terms of tax efficiency, Spain's tax code is pretty complicated, comparatively speaking, to other countries around here. And you can do a lot to optimize your taxes in Spain. So that's good. That's good news. The bad news, or the complicated part of it, is you should work with a tax advisor on the US side, a tax advisor on the Spanish side, and then depending on what they advise, we can implement the most tax efficient means of that in your investment portfolio. So there's usually structural changes to make within your accounts, within your portfolio before you become a Spanish tax resident. And then going forward, depending on how we manage the portfolio for generating income, or if you're living off long-term capital gains, there's lots of nuances there as well. Buying real estate, this is another big one. People always ask, if you're buying real estate, we need to treat this like any other investment. So we need to look at it as an investment, take out the emotional side of it, and treat it, what are your options? If you're not buying real estate, what's the opportunity cost of that money? I think I'm running over here, so I'll end it there. We'll have a question and answer afterwards, but if anyone has any other questions, you can send me an email, and I'm happy to jump on a call or answer easy questions in email. So I will hand it over to Lewis now.
Hello. So first off, pleasure to meet you all. And just as you might have seen, as Andres has written in the comments chain, if you have any questions which you think might be relevant for Shane to respond to, feel free to write them in the comments section, just so that you might not forget them at this point, and we've got them noted down. We're going to open up for questions in just a second. Hi, I'm Louis. I'm the worst dressed of the two of us, quite clearly, on the branded t-shirt. And I'm here with Entre Trámites. So we are basically a tax and legal firm. We've grown to over 100 people now. And my background actually was more in Shane's world. I used to work as an economist with Credit Suisse Asset Management. And made the transition towards tax structuring and everything else. So I'm no longer able to comment on any of the financial matters for regulatory reasons. So I will leave that very much to Shane on that. But I can talk to you about what the tax implications of those things are. Now, parts of this, for those who've already been through a deep dive in Spain, parts of this presentation are going to be, we are recording it and we will see what we can do with the recording, Justine. Without further ado, I'm going to run into the key basic tax parts of it. And then what I would love to get to are the questions from you for both Shane and I. And so without further ado, I'm going to crack on with the first slide. So, critical first question. What happens if you live less than 183 days in Spain? And I should have put a little asterisk. And I spend a significant enough amount of time in some other country, such as the US. If you live less than 183 days in Spain, by default, you are usually viewed as non-resident. If you are non-resident, this basically means that any earnings that you make while living in Spain, let's say you move in September, let's say you've been living in the US until the end of August, you make your move, you arrive in September and you start a new job. Well, you would then pay a 24% flat rate of tax on any salary that you make in terms of income tax. You don't go into the regular normal tax system, but you pay a flat tax basis. This is the same, and the more common example is when people think, you know what, I might want to have a home which I'll rent out a little bit, but I'm going to be living still back in the States or elsewhere, in which case Spanish rental income also faces this 19 to 24% flat rate of tax. Now, 19% is if you are living in some other EU country, but if you are living outside of the EU, so for the majority of the cases here, I would guess, and you live outside of Spain, you would face a flat 24% tax on rental income. Critically, you are not allowed to deduct any expenses off this. So mortgage interest and any of the other expenses would not be deductible. On dividends, capital gains, and bank interest, the default is 19%. However, through the double tax treaty with the US, that can be reduced to 15% withholding tax. The tax you pay in overseas, assuming you are in the US, will depend on the progressive scale. Under the US-Spanish treaty, in general, you get a credit for any tax paid in Spain if you are not resident in Spain. Now, I'm going to quickly crack on to the more common scenario. Now, this might be a surprise for many of you out there, if you haven't yet made the move potentially across to Spain and you're assessing it. The US has the lowest taxes in the developed world, except for pretty much Hong Kong, Singapore, and Dubai. Wherever you would move in Europe, your tax burden is likely to go up. And whether that's Spain, whether that's France, whether that's Germany, whether that's Italy. But it depends very much where your income level is. Critically, on investment income, capital gains, interest, dividends, actually the taxation in Spain can be fairly equivalent to the US. And so in general, because Spanish taxes are higher than US taxes, you don't tend to have to worry about US federal taxes. Why is this? Because usually with the foreign tax credits, either because you have paid some tax in the US, which can be credited in Spain, or you've paid tax in Spain, which generates a foreign tax credit for the US, your total tax bill ends up tending to be whatever you would have paid in Spain if you'd paid no US taxes whatsoever. So in general, once you move to Spain, actually the optimization becomes, what should I do to minimize my taxes based on the Spanish tax schedule? There are two key caveats here. One is that if you are residing in Spain, but you are still interpreted by the US authorities in, let's say you're from California, because California's got a particularly sticky situation where you might still have your driver's license, you might still have voter registration, you might still have a doctor. California, even though you've been outside of the country for even over a year, potentially a couple of years, could still view you California resident. So they could superimpose their state income taxes. Now, with a couple of subtle pieces of planning as you're leaving, you can make sure you don't get caught up in California or other states such as Portland, Oregon's tax web. Now, that can include re-registering into other states, or even if you're in a state with state income tax, some of them will not continue to pursue you once you become non-resident. However, the definition of non-resident can be a tricky part. So that's one of the big tips. The second big area is knowing that taxation in Spain tends to be a bit higher than the US, or potentially significantly higher. As an example, in ordinary income terms, once you go above 60,000 euros in Spain, you will be paying a 45% plus tax rate, approximately. Tax is individual, not joint. You can technically file as joint, but it's pretty irrelevant. So rebalancing assets between partners can really make sense before you make your move to Spain. And if you are, say, already retired or have access to your IRA, sometimes it makes sense to do a preemptive withdrawal. For instance, if you're Texas tax resident, maximize all your withdrawals up to that top 24% rate of tax. So use your first tiers and maximize your joint income just before making your move. Critically, and you can guess this from the 183-day point, also one of the biggest pieces of advice we give to almost every client is, please, 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 if you are thinking of moving in May or June, don't move July 5th, and you're going to save yourself a lot of taxes in that first year. Because as long as you move July 5th onwards, you will not be taxed on any of the money you've made from January ongoing, and you will be considered non-resident for taxation for Spain for the remainder of the year. If you move in May or June, you will be taxable back to January. This has got people potentially caught out who, for instance, had the habitual residence sale, your primary residence sale deduction back in the US, thought you were paying no capital gains tax on the sale of your home. You sold it in February, you moved in March. Tricky thing is, Spain still would view you as tax resident because you're there for more than 183 days in that calendar year. So critically, whenever you're looking at house sales, as Shane pointed out earlier in this call, critical areas to consider. If you're already near retirement age, preemptive IRA withdrawals, not all of your IRA, just to be clear, but preemptively withdrawing a bit of a chunk can be an interesting strategy. Realizing capital gains within your Roth IRA, rebalancing assets between couples before moving, and looking out for your primary house sale. Now, in terms of taxation, some of you might be moving as an employee. I will get onto a special set of options to do with Beckham's Law, which is a special regime, in a second. But in general, what taxes would you pay if you're an employee? You'll pay the Social Security tax, which is roughly 6.5% on the first 5,000 euros a month, and the progressive income tax, which varies from 0 to up to 47, 48, 49%, depending on the autonomous community you live in. If you're self-employed, you will pay Social Security and income tax. Under all the complexity, actually, Social Security plus income tax pretty much adds up to a flat 33% tax on the first 55,000 euros, and then jumps to a 47% tax rate once you hit around 55,000 euros. So on everything above 55,000 euros a year. The reason for this is Social Security is regressive while income tax is progressive. So if you make 15,000 euros, you'll pay 3,600 euros in Social Security. But if you make 150,000, 10 times as much, you only pay double, about 7,300 euros in Social Security. So Social Security is regressive, taxing the lowest earners highest, whereas income tax is progressive for the self-employed. And this is an area which can generate a lot of confusion because you'll see lots of tax tables. For simplicity, just think 1 in 3 euros and then 47%. Now, if your self-employed activity is for working, let's say, as a contractor, digital nomad, anything else, for a US firm as a 1099 contractor, that is B2B consulting. You do not need to worry about VAT whatsoever. VAT is a sales tax, is the equivalent of sales tax. If you are selling directly to consumers, let's say you are doing life coaching, let's say you are doing, you open a restaurant or anything else like that, you will need to consider VAT and sales tax. VAT is far broader than it is in the US and often covers services which would not otherwise be covered by sales tax in most US states. On top of that, VAT is 21% on the standard rate in Spain. So if your key piece of work is to ending retail customers or anything else, VAT and understanding that is a critical part of a move. If, however, you are just doing B2B services, there is no need to worry. You do not need to think about VAT. In fact, you will just always be reclaiming VAT. And with limited companies, it's very similar, except the only difference is, like a C Corp in the US, there could be corporation tax implications. Now, if you're looking to go and be self-employed or limited company, I would definitely recommend having a consultation call because there are trade-offs depending on the path you take. Now, I'm going to skip these parts just to give a quick idea on obligations. Basically, all of you are going to be obliged to file an income tax return in Spain if you move to Spain. Why is that? One of the mistakes you'll find from Spanish advisors, they say, oh, well, if you make less than 22,000 euros a year, you don't need to file. Maybe you've retired early, you're not withdrawing anything from your funds, and you've just got a little bit of investment income. Actually, there's a separate clause if your income has no withholding taxes from overseas. So if your overseas income is greater than 1,000 euros a year, you always need to file in Spain. That does not mean you need to pay taxes, but you always must file. So if you are living in Spain, you are going to need to file income taxes. If you have over 50,000 euros in either bank accounts, real estate, or stocks and shares, in any of those categories, you are obliged to file the Modelo 720, which is basically an informative filing so the Spanish government know what overseas assets you have. That does not mean you need to pay a tax on them. There is a registration form when you arrive, which is very important if you're looking for importing products. So for instance, your personal goods, you moved out of your home, you want to move your old sofa, maybe some jewelry, maybe things that you're bringing with you. The form 030 is very important to register that you've arrived in Spain so that you do not face import tariffs when bringing that into the country. And that's often a little barrier which people face. Finally, one of the big tax considerations, and the only bit which really varies by autonomous community, lots of people come here asking, I need to know where the lowest income tax is. In general, income tax varies almost not at all in Spain. The only exception is for significant earners. If you've got more than 150,000 euros of income, $150,000, Valencia does have a slightly higher, at least significantly higher tax burden on income. But outside of that, almost no state has a notable difference in income tax. The big areas where it does matter, and there is a difference, is on wealth tax. Some regions have an exemption. So I'm just going to skip on the word. Some regions have only a 500,000 euro exemption. So for instance, Catalonia, if you have more than 500,000 of assets, you can be taxed on a progressive rate going from 0.2 to 3.5, 3.6% on assets you own above it. So this can be really significant. Whereas if you are with Shane in Sevilla, in Andalusia, there is a 3.7 million exemption. And they have a trigger law in place that as soon as the federal government gets rid of this grand fortunes tax, there will be no wealth tax in Andalusia. The same is the case in Madrid, Cantabria, Murcia. The Balearic Islands have something almost the same. And then the normal deduction is 700,000 euros. Now, you might be thinking, well, hang on a second, I've got $1 million. I'm going to get absolutely screwed by this wealth tax. I should definitely not consider Catalonia. Take a moment, take a breather. It's okay. Basically, the wealth tax becomes a significant issue if your assets, and remember, assets are individual in the same way that taxes are individual, are more than $1.5 million. As soon as you go above $1.5 million, I would say wealth tax should be a significant consideration in thinking where you might want to live in Spain. You'll still have some obligation, but because of the progressive scale on it, it won't be the biggest issue. When you're trading it off versus rental income, rental costs, where you want to live, different aspects of different cities. But if you if you have above $1.5 million of assets, it's definitely worth considering. If your assets of a combined partner are more $6 or $7 million, you really need to look at how you might want to rebalance between the two of you before making a move. And why is this? One of the last things which we mentioned, inheritance tax. In the US, you and your partner, if you have a partner here, are viewed as almost one and the same person by the tax authorities. Gifts between you are a unit, you are together, you're a household. In Spain, it descends from the French Napoleonic civil law system, and it very much sees your bloodlines as separate until they are fused in the form of your children. As such, technically, gifts between yourselves are taxable between spouses. However, in practice, most regions of Spain have introduced 99% exemptions from anything between partners. However, if you want to do a rebalancing, it makes sense to do it before you make the move, just to make your life a little bit easier. Now, I'm going to just quickly give you a quick overview of the general tax rate so you've got an idea. This is the average tax rate across Spain. It varies very slightly by autonomous community, But just to give you an idea, the top rate in Catalonia is about 50%, and the top rate in Madrid, I think, is 45 or 46% now. So between the lowest taxing and one of the highest taxing autonomous communities, even at the very highest income tax rates above 300,000 euros, the difference is a few percent. It's not the biggest difference in the world. These are significantly higher than you will be used to back in the States. However, I do want to mention the difference in living cost is substantive. One area we didn't touch on, which is very interesting. Your global income is taxed when you're in Spain by default. There is one key exemption. If you are from the US, under the US-Spanish treaty, and you receive a public sector pension, i.e. you worked for, let's say, Houston city government, city hall, you worked for the police in Nevada, and you have a state pension, a defined benefit pension from the US state. That is only taxable in the US. Social Security is taxable in both Spain and the US, because it's not linked to a work for the public sector, but any work that you did for the public sector. So if any of you or any of your partners have a public sector pension, this is what we call progressively exempt. That means it will slightly affect the tax on the rest of your income, but it is untaxed in itself. Now, in awareness of time, I'm just going to go and touch on one last thing, which I think will be relevant before opening up to questions, which is the Beckham's Law. So the Beckham's Law is a special tax regime where instead of paying that progressive rate, you can get access to a potential flat 24% tax on the first 600,000 euros of earnings. And you can be shielded on any tax on your passive assets overseas, i.e. dividends, interest, capital gains, no wealth tax. The most common way of getting this is if you move as an employee of a company in Spain. The second most common, you can move with a W-2 employment contract from the US as a posted worker under what's called a certificate of coverage. And the third most common eligible reason is you set up a company in Spain under the entrepreneurial, as an entrepreneur. If you go and enter in any of those three criteria, you can have access to the Beckham's Law, which makes a substantive difference, which means for the first 6 years, you can pay this lower, flatter rate and have shielding of taxation of your overseas assets. This is particularly interesting if there are any entrepreneurs who might be eligible for the qualified small business relief in the US and may not have yet sold their business, because that gain would be completely untaxed in Spain, should you get access to the Beckham's Law. Now, in awareness of time, and I'll just kind of freeze on that, please, I would love for questions for both Shane and I on what you have. We have 18 minutes now to respond to any questions you might have to the best of our abilities. Please. I suppose we've got some already written. I don't know, Hugo, do you want to decide on who starts or where we're going?
Yeah, should we start with the ones that are written? Give anyone else a chance to get the questions ready. So Justine says, will we be able to rewatch this webinar? I think the answer is yes. We're recording it, and we'll probably email that out in the next few days at some point. Is that right, Lewis?
That's absolutely correct, yes.
Mick said, before moving to Spain, are there any actions one can take to qualify for the Beckham Law? Purchase a company, start a company, that sort of thing.
Okay, so yes, it should definitely be preparatory, because one of the critical parts of the Beckham's Law is it states that your reason for move must be because of this. Now, this is a slightly stupid thing because you move for many reasons. And so the actual legal classification is that you completed this in an order which seemed logical. If you buy a company and it's a true operation and you establish yourself as the director of that company and you do work in it, or you've got any operations, you should be able to get Beckham's Law under the director clause. Now, if it's a company which has no employees whatsoever, there is no other substance, they have a special element which states that if this could be basically just you as a freelancer with nothing else, we can ignore it in its entirety. There is a curious other possibility, which is that exemption or exclusion doesn't apply in the case of being approved for an entrepreneurial visa. So if you apply and get approved by the Spanish government as an entrepreneur, you are allowed to have permanent establishment as an individual in Spain and still get access to Beckham's Law. So you don't necessarily need to have employees after you start up a business idea, as long as the Spanish state judges it to be entrepreneurial. Now, I'm going to give you a couple of caveats because we also do immigration, tax, we do the whole chain on this. Spain has a company, an organization called Rise Up Spain. Rise Up Spain is sponsored by their international export agency, ESEX. It identifies the 50 most promising startups internationally which they want to bring to Spain and gives them awards and pays for lawyers to get them into the country. Only about 30% of them got approved visas, which is the same success rate that we pretty much see across the board of about 20 to 25%. We've seen businesses which I will tell you have no validity or no valid reason I can imagine anyone would classify as innovative, being classified as innovative and approved. And we have others which don't, which have the opposite. Now, there are other concoctions which people do, being hired through a highly qualified visa and gaining access to it. But our general golden option is apply for the entrepreneurship visa first. If that doesn't work, there are pivots. But be aware that the success rate is about 25%, 20 to 25% on average. And even the Spanish government don't know their own criteria, apparently, which is kind of
That's very helpful. Thank you.
Thanks. So Brenda says, can you talk to how you advise folks on US bank account maintenance when you no longer have a US residence that still meets Patriot Act requirements? Also, the impact of state residency.
Yeah, I can address that one. So there's, in theory and practice, I think in theory, Patriot Act wants you to have a valid US address that they can verify. So they don't want you to use one of these PO boxes or fake kind of mail forwarding services. In practice, what a lot of people do is they use a trusted family member. And then before you move, you call your bank, run them through that scenario and see if they're okay with it. They're much more flexible than the brokerage firms are. The other option is there is a credit union called the State Department Federal Credit Union. And if you join them, they're happy with you being an expat. So you can use your address anywhere in Europe. To join them, though, you have to be a member, like credit unions. So if you join a group like American Citizens Abroad, for example, then you can have access to joining the State Department Federal Credit Union.
Thank you. Jan says, I have part of my IRA in a managed account and invests in established EU companies that pay dividends. Is this a good strategy for a possible move to Spain?
I'll take that one as well. I don't know what this fund is, so I'd have to look at that. But in general, you do want to address the currency risk, and that's one way to do it, is to invest in an asset manager or a separately managed account or an advisor who manages the currency risk like that. Yeah.
The only caveat, just to make sure people know on the tax side on that one, is that depending on the double tax treaty that you have between the US, the individual European stocks, the dividends which are being paid out of them might face significant dividend tax withholding in the jurisdictions where they are. And depending on your IRA is, of course, tax shielded. So one of the parts is dividends you receive in the US from US entities and UK companies out of interest under the double tax treaty. There is no withholding tax on any dividends received. However, lots of European stocks pay higher dividends than US stocks do as a share of overall value. And they have to pay tax withholding. So as a pivot, any of your asset portfolio, exactly as Shane was saying, is completely correct. Like the European, if you have a European stock exposure, it diversifies you away from the US. However, just so people are aware, there is a little bit of taxation which you're not getting the full relief on, because you might be paying 15% to 25% dividend tax on any of the dividends on the underlying European stocks. Would that be correct, Shane? On my understanding?
Yeah, I think so. I think this is a great example for why we need to work as a team. Before you move, review your specific case and make sure that nothing is causing a headache, either before or after you become a tax resident here.
Yeah. But it's a great hide. And one of the funny things you'll find is lots of investment banks are not actually allowed to tell you tax-wise that this withholding tax is taking place. There are regulatory restrictions which prevents them from giving anything which could be interpreted as tax advice. And that can be the equivalent of, if it's 25% withholding tax and a 4% dividend, that's like a 1% management fee in taxes disappearing without realizing it. So this is why there's like these little nuances which sometimes aren't in there.
Yeah.
Thank you. So Jason says, if I maintain US residence but buy a residence in Spain and stay less than 183 days a year, would we not be considered tax residents in Spain, not be required to file Spanish taxes unless we have Spanish sourced income?
If you're less than 183 days, but you are no other country for 183 days, it then goes to a secondary trial, which is, where is your center of family and economic life? Usually Spain, if you're on a visa or anything which makes you resident in Spain, will consider you definitely taxable in that case, unless you can show you are more days, let's say in the States, and you maintain a permanent home. And under a clause, they are now not allowing non-lucrative visa renewals. So they're on if you do exactly that and don't declare your taxes. They say that you cannot renew your NLV as it's a requirement. For instance, if you were planning on going 180 days and then spending the rest of the time traveling around Europe, you are definitely Spanish tax resident because you have no center of life back in the US, basically. So that's one thing to watch out for if you are looking on that. So the 183 is like the hard rule, you're definitely in it. Below that, there's, okay, less than 183, but not 183 days anywhere. Where is your center of economic life? So it's a bit of a tiebreaker.
Thank you.
Oh, and there's a non-resident tax on empty homes in Spain. It's a very small tax, but you need to file it every year. About 0.1% of the value of the property. 0.1, 0.2.
Nick said, and what tax forms must be filed for a non-resident who owns a home or apartment in Spain? I'm not sure if that refers to Spanish or US tax forms. Presumably
Spain, it would be the Modelo 210, which is the non-resident. If you rent it out, it'd be for rental income. If you don't rent it out, it's for what they call imputed rental income, i.e. what a theoretical rent would be. This is the tax I just referred to on the prior question, which is like a tax on non-resident property. That's the wrong way of putting it. Tax on overseas owners of property in the US and in Spain, which are not rented out. Would there be any asset filing requirements in the US, Shane? You've got it for financial accounts, but does it apply to property?
That's a good question. I'm not sure.
I don't believe it does. Those are sort of FBAR and FATCA requirements. I'm not a tax advisor, but I'm pretty sure that property itself isn't kind of a financial asset to report.
I don't think so either, but I'm also not a tax advisor, so I was...
Unless you own it through shares in an entity. So if you buy it, so be careful if you buy it through a limited company or something like that within Spain, you could be caught up by that. So if you get into any from these investment vehicles, just remember there is a filing requirement. Yeah, I think I'm aligned with both of you, but that's the only area where it could be a bit weird.
Brilliant. So Brenda says, we have ETFs both in brokerage and in IRA accounts. Would we be required to liquidate these before moving if they were transferred to, for example, Schwab or Interactive Brokers?
Yeah, usually you're not required to liquidate them. The PRIPS rule, which I was talking about before, if they were with Schwab, for example, so Schwab, let me take a step back on that. They have retail clients and then institutional clients. If you open an account yourself with Schwab, you'd be considered a retail client, and then you still can't buy new ETFs. You can hold them, but you can't buy new ones. If you're an institutional client, so you work with an investment advisor in the US, then the PRIPS rule with Schwab exclusively doesn't apply to your account. So we can buy US ETFs through a US firm on your behalf. So the long way around is, in either case, you're not required to sell them. You just can't buy new positions with Schwab. Every broker is different, though. So some of them, they would, some of them wouldn't transfer them over, but it depends on the broker. So you need to speak to them ahead of time.
Thank you. Jan says, thank you for looking at the Logan Capital International Dividend Managed Account I have in my Schwab IRA. I do see that they're deducting the foreign tax when dividends are being paid. That's reference to a previous question.
Yeah.
So that's all the written questions. Has anyone got any questions they'd like to either type in the chat again or just ask our panelists? Yeah, feel free if anyone has any questions they'd like to ask, just to unmute and ask away.
Hi there. Question around, you mentioned sort of rebalancing between partners. So we currently have joint brokerage accounts. Would those, for tax calculations, those be split 50-50, or would we be advised to explicitly make two individual accounts?
So joint accounts are viewed as 50-50 owned between the two people. However, caveat, always make sure to check they are joint and not in your name with somebody registered as the beneficiary should you pass. Because one of the confusions which sometimes occurs on accounts is you're like, oh, it's a joint account. Oh, it's not. And the other thing is, if you're looking at balancing assets between it, for instance, your IRA 401k will never be a joint account. And so Roth IRAs, 401ks, those accounts, you need to add up as the total balancing amount if you think you might be entering into wealth tax. So if your assets are large enough that wealth tax is a consideration, you might want to have 2/3 of your non-retirement accounts put into one of the two of your names, 1/3 of your non-retirement accounts if the retirement accounts are weighted in one of your names. So just always remember, you should be looking at the portfolio in its entirety, not in isolation. Now, there's a couple of other trade-offs, which is to do with, okay, withdrawal rates and everything else. But because interest, dividends, and capital gains has such a flat tax on that, yes, we do all the tax filing. We do everything boring in Spain, basically. But yes, so on the on your question, that's the only caveat I would say on the joint accounts. Remember the difference between beneficiary and joint, and view the whole portfolio when doing rebalancing, not just one account.
So quick follow-up, since you were talking about wealth tax. I feel like I've seen inconsistent information as to whether IRAs are included in that wealth tax calculation.
They're included. They're fully included. The area where there was doubt was IRAs before you started drawing them, whether they were excluded or not. And the tax authorities gave directly contradictory responses. The general interpretation has become that IRAs are taxable. Now, we have some clients, we very explicitly tell them, this is at your discretion of risk of what you want to decide at this point if you are approaching it if they are not yet able to access the IRA. Because if you're not yet able to access the IRA because of your age, you don't need to put it in the Modelo 720, and it is unclear from the legislation and from the Spanish authorities if it must be declared. But once it's accessible, yes, it must be declared.
Got it. Thank you.
And yeah, similar question to clarify: do retirement accounts, US retirement accounts, count towards the Spanish wealth tax thresholds? Is that similar?
Yes. Yes.
Yeah.
Yeah.
Okay, we've got a couple of minutes left. If anyone has any other questions.
Shane, I'm thinking if no one else has a question on that, the PFIC. I think PFIC's a very important thing to note for people. I know you touched on it very briefly, but this is a very important thing for anybody who's, because I know the general panic and the move away from the US and looking for, okay, can I put investment assets outside? If you could just repeat the PFIC problem,
Sure.
Because I can tell you how this can become a double problem with PFIC.
Yeah, I think, if you're doing this yourself, your investment management, a lot of times if you move over here, you might think, well, I want to have exposure to the euro, I'll buy a European mutual fund or a European exchange traded fund. And they'll sell them to you. You can buy one if you open your own account with Interactive Brokers or some type of de Giro, any brokerage service in Europe. You just go on, you buy the fund. Any mutual fund, exchange traded fund that is domiciled in the EU is going to be considered a PFIC, a passive foreign investment corporation, for US tax purposes. Sometimes even money market funds. So it's important to avoid those, as Lewis can tell you, at all costs.
And the classic example would be, let's say you get into what's called an accumulating ETF in Europe. If you invest in an accumulating ETF where it doesn't pay out dividends or anything else, and it's reinvesting within itself, in the US, you will face 37% potential tax under the PFIC clause on any returns which are going on within it. And then in Spain, when you finally get a capital gain or realization, you may face Spanish capital gains tax without the relief from US tax under the PFIC arrangement. So you can end up a mad situation of 55% effective tax on capital gains. This is why you need to be very careful when dealing with PFIC, particularly on anything which is called an accumulating fund, because of them not being recognized in the US in the same way, and in Spain, them being taxed at the moment of exit. So just a big hazard warning there. But Shane will be able to go through that if anybody gets on the call with him on that. But there's some of these weird nuances you'd never think about. I'm afraid I'm going to need to bounce because I need to be on a direct call right now with a client, unfortunately. Shane, there are a couple of last investment questions which have just landed. I don't know if you'd like to take the last couple without with me abandoning you before then all closing off. And I know that's bad form as a joint host on this webinar. The 60 minutes have run ahead so quick.
Yeah, understood. No, that's okay. Yeah, I can answer these.
Have a fantastic day, guys, and we'll be in touch with any information you need. And trámites we're here to help. Okay, thank you very much. Bye.
Yeah, I'll just jump in on these. So, Lauren, your question about investing in strategies we recommend for Americans living abroad. So, U.S. ETFs, they're a good option. I think we need to look at your situation in detail. But in general, one of the big differences from having a diversified portfolio in the US, once you move over here, you probably want to have more global diversification and also exposure to the euro. ETFs are a good option. Individual stocks, individual bonds are your other options. You can't buy mutual funds once you live over here as an expat. Mutual funds need to be registered where they're offered. So US mutual funds aren't registered in the EU, so they can't be offered or sold to people living over here. So a lot of times in the US, you look at your portfolio, it's probably mostly mutual funds. You can't continue to hold or buy new ones once you move over here. And then the next question, is an ETF strategy like VGK, Vanguard, FTSE Europe okay for your recommendation? We use that one actually in some portfolios. It's a good fund. It depends, again, on your specific situation.
Well, thank you very much to Shane and Lewis, who had to jump off. But if you have more questions, feel free to get in touch. We've put both firms' websites in the chat if you'd like to grab those before we finish in a minute. Do get in touch. Just to clarify, Euro American Financial Advisors isn't a tax advisor. But we work in partnership with tax advisors, and Shane does investment advice, financial planning for your move to Spain and once you've moved. So if that's something you'd like to discuss, get in touch. And Lewis and Entratramites for, as he said, all the boring stuff, the paperwork, visas, they do taxes, and if you need to set up a business and lots of other sort of paperwork you'll need or you may need moving to Spain. But thank you all very much for joining us today, and we will forward a recording as well of the webinar in a few days' time.
Thank you, everybody. Cheers. Bye.